Hey guys, so today I'm going to talk to you about my investment strategy. I thought it would be a good topic to talk about, especially since there's so much going on right now in the stock market, especially recently with the whole thing with GME and Wall Street bets. I mean, people are really paying attention on how people are investing. And coming out of this pandemic, people are really leery about savings and really savings in a traditional savings account. People are just kind of hesitant to do because they're not getting any returns. Bonds also aren't doing that hot. So the stock market's where everyone's like going towards. So I thought we'd do a video on what my investment strategy is, what it really has always been, and maybe some things that I've changed in the past couple years. So if you're interested, keep on watching.
Just a little bit of money. Maybe doubling it and then doubling it several more times. I don't know. Kind of just for fun. I was thinking, do you have any tips or ideas about sure things, like a boxer who is going to throw the big fight? Like he's tied into some crooked dealings and maybe his kid is sick or something. Like, who would I call about that?
Well, and if you're not a subscriber, please subscribe. I really appreciate your support. It helps me stay motivated to do these kind of videos and share my ideas, my strategies, and how I was able to accumulate over $300,000 in my portfolio and over $500,000 in my entire net worth. So, my strategy, it's pretty simple. You've probably heard this before, but I thought, hey, let me share you my strategy because you might help. It might be something that you might want to follow, or you might tweak it, or you might take some parts of it that you can apply for yourself, okay? So the first piece of my strategy is very boring. And the first piece of my strategy is an emergency fund. Yes, emergency fund, cash on hand, however you want to call it. It's just having cash in a basic savings account. What I recommend is at least 3 to 6 months of your expenses, of what you spend on any given month. You want 3 to 6 months of it. I personally have about 5, maybe 6 months worth of expenses in a money market account. It's a basic high yield interest savings account that I can dip into it whenever I want in case an emergency happens, or if there's a really good deal, I could dip into it and put some money into investments or what have you, but it's just there. I don't touch it. Now, let me reiterate. Now, dipping into that money for investments isn't necessarily an emergency, but I have it padded up to 6 months, almost 6 months. So even though I bring it down to like 3 months, I'm okay with that personally. But that's what I recommend, is having cash. Why? Why is having cash important? Because that's my insurance, my personal insurance. Now, we pay insurance for cars, we pay insurance for houses, we pay insurances for all sorts of things that we never get back. We just pay it and we never get back. And those are to cover emergencies, right? You might think, well, why don't you put it into a mutual fund? Why don't you put it into S&P 500 index funds? Because you could, pretty much flip a switch and get it out. That's true, but I feel this peace of mind, it's more than just the numbers, it's this peace of mind knowing that the money's there. Now, you have to understand, I went through the 2008-2009 crash. I also felt a little bit of the 2000, I'm that old. But I saw what had happened with my family. I myself was impacted greatly. I lost a lot of money. I went homeless I went homeless. I was living in people's garages. I was bouncing from place to place. I was essentially homeless. And so for me, it impacted me in a psychological way. So giving me that peace of mind knowing that that cash is there is just helpful for me. So that's pretty much it. But I recommend everyone having some type of emergency fund, because when you are building wealth, you don't want to use credit cards. You don't want to use debt. You don't want to use a credit card for emergency fund, because that goes against you. That's counter building wealth, because the number one thing that helps you build wealth, the number one thing, okay, let me take it back. The 2 things that build wealth is cash flow, monthly cash flow, putting away into investments. And 2, it is the compound effect, the compound interest effect. Those are 2 of the most powerful things to build wealth over time. And so when you have debt of any kind, not only are you interrupting your cash flow because you have to take that cash flow and put it towards your payments every month, but the interest is counting against you, is working against you. You could be over here working hard trying to get a 12%, 13, 14% return on your money is working against you. So I try to stay away from debt. So that's the second thing. So the first thing is have an emergency fund. The second thing is get out of debt or avoid debt as soon as possible, because again, it's going to impede your ability to really grow your investments, you grow your portfolio. And that's even car loans. Car loans are one of the biggest culprits, and they don't get you because of the interest rate. They don't get you because of the amount necessarily, but the monthly payment that goes to it. I mean, the average payment now is like $400 or $500 a month. That $400 or $500 a month can go into investments, and you're losing out a lot. And here's what happens. You get into the habit of getting one car, bouncing to the next car, bouncing to the next car, and you live your whole life making car payments, an average of $400 or $500 a month. That money could be going into investments that accumulate over time and taking advantage of the compound interest. Number two is get rid of debt. Don't use debt. I understand if you do. Houses, I know we can get into that, but generally speaking, let's get rid of debt. Number three, my mother's strategy is to then grow a nest egg for long term. I mean, if you just plug in any money, any numbers in these investment calculators for the long term, the longer you wait and the longer you invest in any type of investment, whether it's a single stock or whether it's a mutual fund, whether it's an index fund, the longer that you hold that investment and it compounds year after year after year, whether it's a 12%, whether it's a 6%, whether it's a 30% annual returns, it compounds and it grows over time. So the third thing is to start some long-term savings. And the best way to do that, guys, to get started is either a Roth IRA or your 401k or 403b. And then there's others as well, but something that you can hold for the long term that forces you to keep it in there. My Roth IRA forces me to not touch it until I'm 59 and a half. Same with the 401k. So if you're working for someone, if you're employed, take advantage of that. You can always roll over that 401k if you change jobs or you start a business or what have you. You can roll it over into a Roth IRA because that grows over time. Not only does it force you to keep it for a long time until you're 59 and a half, but it also grows tax-free. So when you pull it out, you're not paying taxes on it. So it's an incredible tool. That's the thing that I use to help me grow my net worth and grow my portfolio. The fourth thing is to have a middle, short to long-term type of account. And mine is held in E-Trade. And it's also a little bit in some other investment account that I had with my other employer. So the combination of those two is my middle to short-term to long-term, middle-term portfolio and investments. And what's that for? That's for the next car, right? I pay everything cash. So just a caveat to that is I pay everything cash. I don't like to use debt, like I said before. And so I'll save up for things like my next car, I'm gonna pay for cash. And I'm planning to get a Tesla. So I'm gonna save for that. I'm gonna build my worth, but I'm gonna build my net worth, but I'm gonna use index funds, and I'm gonna use some safer investments, but they are going to be in the stock market. So it's going to be stock market related. It's not going to be necessarily single stocks. Well, let me take that back. There is some single stocks, but the majority, that middle is going to be like index funds. And so that is what I'm going to use to save for things and then pull it out in the next 5 to 10 years. So the middle is like 5, 10, maybe 20 years. My long-term, my Roth IRA, which by the way is also in index funds and mutual funds for the long-term growth stocks, but they're all very diversified funds, very, very safe for the most part. They're very safe. I mean, they're safe. And that's like 30, 40, 50 years. And then my short-term, that is my riskiest portfolio, and I use Robinhood for that. And my riskiest portfolio is like single stock trading. If I don't like the company, how it's performing, I get rid of it. But that's a small portion of my portfolio. That's a very small portion of the portfolio. And I know like traditional investors, and I even myself thought of not doing that. I didn't like the idea of speculating. I didn't like the philosophy of it. But over time, I've grown to really enjoy it. I really like digging into companies, seeing what they're about, digging into their financials, and really determining whether or not I want to invest in a company. So I started doing that, and it's really paid off. I've made really good returns on my speculative trading, even though it's backed by a lot of research and it's backed by a lot of me really digging into the company and what the potential is, whether the company's a value or not. I use some strategies like value investing and price per earning ratios. And I don't want to get into that right now in this video, but it's a small percentage. My Robinhood is I originally started with about 5% of my total net worth. 5% of my total net worth is in Robinhood, my speculative trading. I do option calls on there. So that's my strategy in a nutshell. So let me recap. So emergency fund, that's about 10-15% of my net worth. Then I have paying no debt, that's part of it. Then it's my long term, and that's about 75 to 80% of my net worth is in long term mutual funds and S&P 500 index funds for long term, and I'm not gonna touch it until like I'm in my 60s. And then I have my middle 5, 10, 15 year investments. And then I have my speculative, which is like in the next year. Like I look at that month by month, year by year, day by day. I don't necessarily day trade, but that's my speculative trade. And that's about 5%. So this is about 10, 20%, and this is about 75%. I'll probably throw up a little pie right here to kind of show exactly what my percentages are on each one. And that's it in a nutshell. When it comes to my portfolio, that's what it is. I also have a house and I have tons of equity, which builds into my total net worth, but I'll discuss that probably in another video. But that's it. That's basically my strategy in a nutshell. And I thought I would share that with you. Hopefully you could take some takeaways from this. That's it. If you haven't subscribed, please consider subscribing. Just hit the subscribe button. It's easy, it helps me out. I would appreciate it. It's free. You're not subscribing to anything except for just me, my videos. And if you like this video, hit the like button and we'll see you in the next one. Bye-bye.